Hello friends, let's start with the accounting standard 12, that is government grant. Now what is government grant? Basically government grant is nothing but help given by the government to different persons, different businessmen so that they can achieve their target, they can start their ventures, they can start their business activities and many such things. So government helps the businessmen in various areas or in different ways. Let's understand what ways are given and how government helps each and every businessman in different sectors. Now, first of all, let's see. Government grants are assistance by government in cash or kind to an enterprise for past or future compliance. So, government grants basically are given in the form of cash or in the form of kind for past or future compliance. Or suppose if there is any past obligation, means which the company wants to fulfill in the near future, or some future compliances, means if the businessman fulfills the conditions, then government will give the grant with certain conditions. So basically government grants can be given in cash or kind for meeting the past obligations or fulfilling some future obligations subject to certain compliances. Government means central, state government, government agencies, local, national, international. So government includes everything: local, national, state government, central government, every people. So basically here we are going to discuss the accounting treatment of government grants, how the government grants will be accounted, and what are the accounting treatments. Government grants will be recognized only if there is reasonable assurance that the conditions attached will be complied and the grant will be received. So basically government grants, when you should recognize in the books of accounts, when you have a certainty that you are going to receive the grant and all the conditions you are going to fulfill which are laid down by the government. So very clear, government grant should be recognized in the books of accounts only when you are certain that you are going to receive the grant and you are going to fulfill all the conditions. I hope it is very clear. So basically this is the introductory part of the government grant. So when you should recognize government grant, everyone you should remember point number 2, what is government grant and when it should be recognized. It should be recognized only when there is a reasonable certainty that you are going to receive the grant and all conditions you are going to fulfill of the government. Now, there are two approaches for accounting of government grants. So you have two accounting approaches. One is capital approach, one is income approach. I repeat, one is capital approach, one is income approach. Guys, listen to me very carefully. After discussing the entire point, I will prepare one summary for you, a short recap. Now, what is capital approach? Under this approach, grant is credited to capital reserve and treated as a part of shareholders' funds. Now, suppose if you follow capital approach, means the grant received is credited to capital reserve. Now, what is capital approach first of all? Means whatever grant you receive, you treat as a part of shareholders' funds. Hence, when you are following capital approach, the grant received should be credited to capital reserve, and capital reserve comes under that reserves and surplus, and it should be treated as a part of shareholders' funds. So, whenever capital approach is followed, grant received should be credited to capital reserve and treated as a part of shareholders' funds. Now, second approach is income approach. Under this approach, grant is credited to P&L over one or more periods. The unamortized amount is carried in deferred government grant account. Let's understand this very properly. Suppose if we are following income approach says that whatever grant you have received, you have to credit to P&L over one or more periods. The unamortized amount should be carried in deferred government grant account. Now, there are two approaches basically. One is capital approach, one is income approach. Now, what is capital approach? Capital approach, whenever you follow capital approach, the grant received should be credited to capital reserve and treated as a part of shareholders' funds. But when you are following income approach, the grant received should be credited to deferred government grant account. The grant received should be credited to deferred government grant account. Every year, you have to transfer part of the income in the profit and loss account. Means, why I am saying this, when you are following income approach, the total grant receipt should be credited to an account known as deferred government grant account. Every year, a part of it should be transferred from deferred government grant account to profit and loss account and shown as income. Till now, understand this only, we'll go into further details. So I repeat, under income approach, the grant receipt should be credited to deferred government grant account. Every year, a part of it should be credited to profit and loss account and shown as income. Now, what part, how much part, I'll discuss it. Now, government grants can be in cash or kind. Government grants can be in cash or kind. That we have already discussed. Now, let's discuss about kind. Non-monetary government grant, that is grant in the form of assets such as land, are recorded at nominal value. So, guys, please remember this. Government grant can be in cash or kind. Non-monetary government grants, for example, assets in the form of land, they should be recorded at nominal value. And if grants are received at a concessional rate, then such asset should be recorded at actual cost. So government grants can be received in two ways, in cash or in kind. If you are receiving in kind, for example, in the form of assets such as land, they should be recorded at nominal value. And if you are receiving at a concessional rate, then it should be recorded at actual cost. So what is nominal value? What is actual cost? Now, if you receive government grant at free of cost, then you have to record a nominal value. What is nominal value? Where you have heard the word nominal value? Face value of a share, 10 rupees. Nominal value of a share, 100 rupees. So whenever you have received a non-monetary grant at free of cost, record a nominal value. If you have received at a concessional rate, what is concessional rate? Suppose one land cost rupees 1 lakh in the market. Suppose if government gives you for 60,000, then what is the actual cost paid by the businessman? 60,000. So if grants are received at a concessional rate, then the actual amount which is paid, it should be recorded at that value. I hope it is very, very clear. So if non-monetary government grants are received free of cost, you should record at nominal value. But if non-monetary government grants are received at a concessional rate, then you should record the same at actual cost. So whatever amount you have paid for acquiring that asset. I hope it is very, very clear till now. So till now, what we have studied, guys, I'll clear this everything and let's discuss. First point we discuss, government grants are help given by the government in the form of cash or kind. Government means central, state, World Bank, all types of governments come into picture. Now, second point we discussed, most important, government grant should be recognized only when its collection is certain and all conditions you are going to fulfill which are laid down by the government. Then there are two accounting approaches for government grant, capital approach, income approach. Suppose you are following capital approach, the grant receipt should be credited to capital reserve and it should be treated as a part of shareholders funds. Suppose you are following income approach, the grant receipt should be credited to deferred government grant account. Income should be recognized in the proportion. Means every year you should transfer a part from deferred government grant account and show it as income in the profit and loss account. How much part should be recognized? What amount should be recognized? We are going to discuss ahead. Now, government grants can be in cash or kind. Suppose you are receiving government grants in kind. Let's assume you are receiving land as assets free of cost from government. Then you have to record the land at nominal value. Suppose you are receiving land at concessional rate, the example which I give. Suppose if a land is available at 1 lakh in the market, and suppose if government gives you at 60,000, then if you are receiving government grant at a concessional rate, then you have to record at actual cost paid by the businessman, that is 60,000. Let's go ahead, guys. Fifth point, monetary grants may be non-monetary grants, may be related to fixed assets or may be related to revenue or related to capital. So now let's go to monetary grants. It may be related to fixed assets or it may be related to revenue, means day-to-day activities, or it may be related to capital. So monetary grants can be received in three ways, either related to fixed assets or revenue related grants or capital related grants. Now, grants related to non-depreciable fixed assets. Again, non-depreciable fixed assets like land are credited to capital reserve. This we discussed just one point ahead. Any non-monetary grants like land, if you are receiving it, it should be credited to capital reserve and treated as a part of shareholder funds. So any non-monetary grant, if you are receiving it, and if you are following capital approach, the same should be credited to capital reserve and treated as a part of shareholders funds. Now, so till now we studied government grants can be of two types, in cash, in kind. Suppose if you are receiving government grant in kind, such as an asset which is nothing but land. If you are receiving it free of cost, recorded nominal value. If you are receiving at concessional rate, recorded actual cost paid by the businessman. Now, after that we studied monetary grants. Monetary grants can be received in three ways, either in the nature of fixed assets or in the nature of revenue or in the nature of capital. Then grants related to non-depreciable assets. Basically, that is kind only. Non-depreciable assets like land, they should be credited to capital reserve. So don't get confused, guys. Government grants can be of two types, in cash, in kind. Suppose you are receiving government grant in kind, for example, assets such as land. If you are receiving land free of cost, recorded nominal value. If you are receiving land at concessional rate, recorded actual cost. Then we went to monetary grants. Monetary grants can be received in the form of fixed assets or in the form of revenue or in the form of capital. Then, then we discussed grants related to non-depreciable assets. So I'll bifurcate everything into simplified way. Now see, government grants are of two types, cash, kind. How many accounting approach? Two, capital approach, income approach. How many types of assets? Two. Depreciable assets, non-depreciable assets. I hope it is clear till now. Now, grants related to depreciable fixed assets can be accounted in the following two ways. Now, how many types of grants? Two. Cash, kind. How many accounting approaches? Two. Capital approach, income approach. How many types of assets? Depreciable assets, non-depreciable assets. Now we are discussing about depreciable assets. If you are receiving grant relating to depreciable fixed assets, it can be accounted in the following two ways. Now, that is nothing but grants are deducted from the gross value of the fixed asset and only the net book value is depreciated. So basically this is nothing but capital approach. This is nothing but capital approach. So whenever you are receiving a grant relating to depreciable fixed assets, you have two accounting treatments. Capital approach, income approach. Suppose you are following capital approach. Whatever grant you receive, deduct it from the cost of fixed asset and only the net book value should be depreciated. I'll give you one example, guys. Suppose you are purchasing an asset of rupees 100. Suppose government is giving you a grant of rupees 40. Then, and if you are following capital approach, then at what amount you will show fixed asset in your balance sheet? 100 minus 40, that is 60 rupees you will show fixed asset in your balance sheet because you are following capital approach. This is what you have written in point number A. Point number B. Now this is income approach. Grants are treated as deferred income. Means how many approaches were there? Two approaches. Capital approach, income approach. See, now if you are following income approach, the grant received should be credited to deferred government grant account. The grant received should be credited to deferred government grant account. That's what they've written. The deferred income is transferred to P&L over the periods and in the proportion in which depreciation on the related asset is charged to profit and loss. So it is very difficult to understand this point. How many approaches for accounting of government grant? Two approaches. Capital approach, income approach. Suppose you are receiving government grant and you are following capital approach. The grant received should be credited from the cost of asset or the grant received should be deducted from the cost of asset and only the net book value should be depreciated. This is in case of capital approach. Now, if you are following income approach, the grant received should be credited to deferred government grant account. Income should be recognized in the proportion you charge depreciation. Now, what is the meaning of this? Suppose you are receiving a grant of 40 rupees. In my example, 100 rupees is the cost of asset. You are receiving a grant of 40 rupees. And if you are following income approach, the grant received should be credited to deferred government grant account. Income should be recognized in the proportion depreciation is charged. Now, what is the meaning of this? Suppose your cost of asset is 100 rupees. You received a grant of 40 rupees. You are going to follow income approach. So, when you are following income approach, your asset should be shown at full 100 rupees only. Now, suppose let's assume the life of the asset is 10 years. The life of the asset is 10 years. Now, let me be very clear. Income should be recognized in the proportion depreciation is charged. What is the cost of asset? 100 rupees. What is the life of the asset? 10 years. So, what is the annual depreciation? 10 rupees per annum. Thus, in the same way, you are supposed to recognize income in the profit and loss account. In the same way means what? 40 rupees is the government grant. What is the life of the asset? 10 years. So every year 4 rupees you will credit it to P&L. This is how income should be recognized in the proportion depreciation is charged. Let's go ahead. Now, government grants relating to revenue is recognized in the P&L over the periods necessary to match them with the related cost. And such grants may be shown as other income or deducted from related expenses. Now I'll repeat one more time. So government grants or basically monetary grants can be received in three ways, either related to fixed assets or revenue related or capital contribution. Fixed assets, if you are receiving any monetary grant related to fixed assets, there were two accounting approaches, capital approach, income approach. If it was capital approach, the grant received should be deducted from the cost of the asset and the net book value should be depreciated. If you are following income approach, the grant receipt should be credited to deferred government grant account. Income should be recognized in the proportion depreciation is charged. My example was very clear. 100 rupees is the cost of asset. If you are receiving a government grant of 40 rupees and if you are following capital approach, the asset should be shown at 100 minus 40, 60 and the 60 rupees should be depreciated over the useful life of the asset. But suppose if you are following income approach, asset should be shown at 100 rupees, income should be recognized in the proportion depreciation is charged. So asset shown at 100, life 10 years. What is annual depreciation? 10 rupees per annum. The same way you should recognize income in the profit and loss account. How much government grant you received? 40 rupees. What is the life of the asset? 10 years. 4 rupees you will show as income every year in your profit and loss account. Now, monetary grants can be related to revenue. So if you are receiving any revenue related grant, you can show it in the profit and loss account over the periods to match them with related expenses. Means show in the income part and related expense show on the debit side, or show it as other income, or show net off. Net off means what? 100 rupees received less related expenses 40, net amount 60. So whenever monetary grants are received in the nature of revenue, means day-to-day activities, you can show either as income and show related expenses on the debit side, or you can show it as a net off. Net off means grant received minus related expenses, net grant you can show. Let's go ahead. The government grant in the nature of promoter's contribution. Who is a promoter? A promoter is a person who gives an idea to start the business. So suppose I am a promoter. I gave idea to start one business which government not have has not even thought of it. Government is very happy with my idea. So government thought to help me out to achieve my targets. So, if any government grant is received in the nature of promoter's contribution, the same should be credited to capital reserve and treated as a part of shareholders' funds, because promoter is nothing but one shareholder of the company. So, any government grant received by a promoter in the nature of promoter's contribution, it should be credited to capital reserve and treated as a part of shareholders' funds. So, till now, what we have studied is very important. Basically, I'll summarize this into two parts. Government grants are of how many types? Two types. Two types. Cash, kind. How many types of assets? Two types. Depreciable, non-depreciable. How many types of grants? Two types. Monetary, non-monetary. How many types of accounting approach? Two approaches. Capital approach, income approach. Now, let's go into one by one. I repeat, how many types of grants can be received? Two types grants can be received. Cash, kind. How many types of grants? Two. Monetary, non-monetary. How many types of assets? Two. Depreciable, non-depreciable. How many types of accounting approach? Two. Capital approach, income approach. Now, let's take one by one. If government grants are received in kind, let's assume you are receiving any fixed asset, for example, land. You should record at nominal value if you have received free of cost. Nominal value means 10 rupees or 100 rupees. But if you are receiving government grant in kind, for let's say example land at concessional rate, then record that asset at the actual amount paid by the businessman. So this was in kind and this was non-depreciable asset. Now let's go for depreciable asset. Now if you are receiving any government grant related to depreciable fixed asset, there are two accounting approaches: capital approach, income approach. If you are following capital approach, the grant received should be credited to capital. Sorry, the grant received should be credited or deducted from the cost of fixed asset, and the net book value should be depreciated. But if you are following income approach, the grant received should be credited to deferred government grant account. Income should be recognized in the proportion depreciation is charged. This is a small recap. Now, let's go ahead. Now, let's go for kind, or sorry, cash. Government grants can be received in cash in three different ways. Government grants received in cash can be in the nature of fixed assets, or in the nature of revenue, or in the nature of capital. Fine. So, if you are receiving any government grant in the nature of revenue related activities, you have to show the grant received as income and show related expenses on the debit side. Second thing you can do here is show government grant received as income, show related expenses as a deduction, and show the net amount as income in the profit and loss. And if you are receiving any government grant in the nature of promoter's contribution, treat the same as credited to capital reserve and treat it as a part of shareholders funds. So this is accounting of government grant, or government grants when received, how it will be accounted in different ways. That part we have discussed. The second part of the AS we'll discuss. Let's start with that. Okay, let's continue. Now AS point number 10. AS-12 does not deal with the following. So these people are not included. Government participation in the ownership of an enterprise. Suppose in my business, if government participates, or government is an investor, investment by government in equity. So if government invests in my equity shares, then AS-12 is not applicable to my business. Tax exemption in the backward or notified area means I am starting business in such areas where there are tax exemption or there are backward or notified areas, then AS-12 is not applicable. Transactions with government which cannot be distinguished from normal trading transactions. So if I am doing regular transactions with government, but if I am not able to distinguish, which cannot be distinguished from normal trading transactions, means this is done with customers, normal customer, this is done with government. If I'm not able to distinguish between the both, then AS-12 is not applicable. So remember, these are the exceptions where AS-12 is not applicable. Now, फर्स्ट पार्ट ऑफ द एएस we studied the receipt of the grant, मतलब grant receive होता है तो क्या accounting treatments है. Now the second half of the AS is if we have received the grant but we have not fulfilled the conditions laid down by the government, then the grant becomes refundable. Guys, one more time, we have a recap time now. Grants can be received in two ways: cash, kind. How many accounting approaches? Two approaches: capital approach, income approach. How many types of asset? Depreciable asset, non-depreciable asset. Now, the same approach, whatever we have followed, if we are violating any conditions, the grant becomes refundable. Let's study that. Government grant becomes refundable due to non-fulfillment of conditions attached and are treated as an extraordinary item as per AS5. Remember, guys, whenever refund question is asked, you have to give a line like this. Whenever the grant becomes refundable, the entire refund or the refund amount should be treated as an extraordinary item as per AS5. Why extraordinary item? Why not an ordinary item? Because grants are not received every day and refund of government grant also doesn't happen all the time. So it will be treated as an extraordinary item as per AS5. Continue. Refund of revenue related grants. Suppose when you have received revenue related grant and you have not fulfilled any conditions, then refund of such grant should be adjusted against the balance in the deferred government grant account, if any, and the balance is charged to PNL. Now, basically, there are only two accounting approaches: capital approach, income approach. So, let me explain you this in a very simplified way. First, I'll explain you if you have followed income approach. If you have followed income approach, the grant received you must have credited to deferred government grant account, and you must have recognized income in the proportion you must have charged depreciation. But suppose due to non-fulfillment of conditions, you are supposed to refund the grant. Now, if you had followed income approach at the time of receipt of grant, then how to reverse the approach, that is important. Now, suppose if you have followed income approach, the grant receipt should be credited to deferred government grant. Now, if the grant becomes refundable, whatever balance is left in deferred government grant account, मतलब जो भी balance बचा है deferred government grant account में, उसको reverse कर दीजिए, balance loss को P&L में debit कर दीजिए. I'll give you this थिंक विद अ सिंपल एग्जांपल. सपोज आई फॉलोड इनकम अप्रोच, मतलब मुझे ग्रांट मिली थी कोई भी पर्पस के लिए, मॉनेटरी ग्रांट्स आई हैव रिसीव्ड एंड आई फॉलोड इनकम अप्रोच. व्हाट entry I would have passed: bank account debit to deferred government grant account. What? Bank account debit to deferred government grant account. Let's take a very simple example: 10 rupees grant received by me, bank account debit to deferred government grant account. Every year I will recognize income in the proportion I'm charging depreciation. Let's assume cost of the asset is 100 rupees. Life of the asset is 10 years. So every year 10 rupees depreciation I'll charge. Now income should be recognized in the proportion depreciation is charged. Suppose first 4 years I followed the rules and conditions, regulations, whatever laid by the government. First 4 years I followed the rules and regulations. So can I say 10 rupees is the government grant? Life of the asset is 10 years. So 10 divided by 10, 1 rupees per annum into 4, 4 rupees, right? So 4 rupees I have already recognized as income. What is the balance left in the deferred government grant account? 6 rupees. Let's assume that in the beginning of the 5th year, I have violated the rules and regulations laid down by the government. And the entire grant becomes refundable. And the entire grant becomes refundable. So what entry I would pass? Deferred government grant account debit 6 rupees. The balance left in the DGG. What is the balance loss for me? 4 rupees. So what will be the entry? Deferred government grant account debit 6 rupees. Profit and loss account debit 4 rupees. To bank account 10 rupees. Now this is the accounting treatment when the grant refund becomes refundable, when income approach is followed. Please refer my example properly what I have explained. If you are not able to understand, please recap it and revise it again the video, that the last 1 or 2 minutes. Basically, when you are following income approach, you are crediting the grant to deferred government grant account. Whenever the grant becomes refundable, the same approach needs to be reversed. So deferred government grant account debit with the balance left in the deferred government grant account. Any additional loss will be debited to P&L and to bank account with the outflow of cash. So this is what they have written. Refund of revenue related grant should be adjusted against the balance in the deferred government grant account. Balance in deferred government grant account, if any, and the balance is charged to profit and loss. Now, treatment of refund of government grant related to fixed assets. Depends on the accounting done at the time of receipt of grant. Now, suppose you have received monetary grants or suppose you have received cash for acquiring a fixed asset. Now, it all depends which accounting approach you have followed when you had purchased a fixed asset, capital approach or income approach. Now, if the grant receipt was deducted from the fixed asset, means you have received government grant in cash for acquiring a fixed asset. And suppose you had followed capital approach. Now let's go back to my example. Let's assume the cost of the asset is rupees 100. I have received a government grant of rupees 40 and I'm going to follow capital approach. So how much amount I will show fixed asset in the balance sheet? 100 minus 40, 60 rupees because I have followed capital approach. Now the grant becomes refundable. So the refund amount should be added to the cost of the asset. That's what they've written. If the grant was deducted from the cost of asset, then the refundable amount should be added to the book value of the asset. So the cost of the asset was 100, grant receipt was 40, and I had followed capital approach. So I must have shown fixed asset in the balance sheet at 60 rupees. Let's assume the grant becomes refundable. The refundable amount should be added to the book value of the asset. Why book value? Because I must have fulfilled conditions in the initial years. So I must have charged depreciation in the initial years. So the refundable amount should be added to the book value of the asset and the revised book value should be depreciated. And the revised book value should be depreciated over the remaining useful life. I know it is very difficult to absorb. So let's take my example. 100 rupees cost of asset, 40 rupees is the grant receipt. What is the cost of asset which I must have shown in the balance sheet if I would have followed capital approach? 60 rupees. Let's assume the life of the asset is 10 years. Let's assume I have fulfilled the conditions for first 2 years. What is the annual depreciation? 60 divided by 10. 6 into 2, 12. 6 2s are 12. 60 minus 12. 48 is the WDV. Third year, I am supposed to refund the government grant. Full 40 rupees. Full 40 rupees I am supposed to refund. The refundable amount should be added to the book value of the asset. What was the book value? 48. What is the refund amount? 40. 48 plus 40, 88. What is the remaining useful life? Can I say 8 years? Out of 10 years, 2 years I fulfilled the conditions. So 88, that is 48 plus 40, 88 divided by remaining useful life, 8 years. So what is the annual depreciation? 11 rupees per annum. 88 divided by 8. I hope it is very much clear. Depreciation on the revised book value will be provided prospectively over the remaining useful life of the asset. This is what I have explained. Now, if the grant receipt was treated as deferred income, again the same treatment. Suppose I have received monetary grant, I have received cash for acquiring fixed asset, and I have followed income approach. What would be the entry? Bank account debit to deferred government grant. Suppose if the grant becomes refundable, what I will do? Whatever balance is left in deferred government grant account, I will debit the same. Any excessive loss, I will debit to P&L and credit bank account with the outflow of cash. So if the grant receipt was treated as deferred income, then the refundable amount is adjusted against the balance in the deferred income account and balance if any is charged to profit and loss. Now, when the grant receipt was credited to capital reserve, when we must have credited to capital reserve, when we must have acquired a non-depreciable asset like land, or when we must have received a government grant in the nature of promoter's contribution. When the grant receipt was credited to capital reserve, the refundable amount is to be adjusted with capital reserve. So these are all the treatments for refund of government grant. Now, following disclosures are required. Accounting policy adopted for government grant, including methods of presentation in the financial statements. So, which policy you are following, which approach you are following, everything needs to be disclosed. The nature and the extent of government grant recognized in the financial statement, including non-monetary assets given at concessional rate or free of cost. So, which type of grant you have received? In the nature of fixed asset, in the nature of revenue, in the nature of capital, including non-monetary assets, if any received. If received free of cost, recorded nominal value. If received at concessional rate, recorded actual cost paid by the businessman. So, all disclosures are required. The deferred government grant will be disclosed after reserves but before secured loans. And yes, if you are following income approach, you must have credited the grant to deferred government grant account, where it will be disclosed in the balance sheet. So it will be disclosed after reserves and surplus and before secured loans. Means we can say after reserves and surplus and before long-term borrowings. I hope the concepts are very clear. Stay tuned. Keep on revising the concepts and videos and stay tuned for further practical illustrations for AS-12. Thank you.